Welcome, everyone. It's amazing to see a full house here. I'm Meghan Reynolds from Altimeter, and it's great to be spending time on stage with two legendary LPs and actually GPs themselves as well that are here to give you perspective on the LP-GP relationship dynamic and the current economic environment for fundraising. On the stage here, you have, I hate to say it, over 75 years of collective asset management experience, sadly distributed evenly. Packard Foundation, Common Fund, Stanford University, Spider Management, Jasper Ridge, Greenspring, Goldman Sachs. That's the perspective that we bring to you today. Each of us have spent time at those collective organizations and have had thousands upon thousands of meetings with GPs and with LPs over the years that we've been working together in the industry with all of you. And I think from that, we wanted to bring some perspective about some of the things we've learned. One of the things that I love to do is debunk fundraising for many GPs out there. I post a lot on X. I write about what I'm hearing from LPs, and I found so many GPs that have come to me really thanking me for putting out there just some common observations and some truth-telling about what I'm hearing. And it's made me more passionate about trying to establish a baseline of our understanding of relationships. I joke that what I wanted to call this panel was, oh my gosh.
He's just not that into
They're just not into you. Relationship advice and what LPs really want to tell you, but what you're too afraid to ask. So I start with that. I'm going to turn to each of them. Maybe I'll start with Seyonne and talk a little bit about Stepstone Greenspring, your program that you're actively investing today. And then we're going to spice up the panel and start with what's the worst thing you've ever heard a GP say in an LP meeting?
Okay, great. Hi, I'm Seyonne Kang. Thanks for coming today. I'm part of the Stepstone Venture Growth team. So we commit to early stage funds, and then we do direct investing at the growth stage. We have a very large secondary practice. And then we also have a large advisory business out of which we underwrite all different kinds of funds, from soup to nuts, from, again, pre-seed funds all the way to what you'd actually call probably more growth equity, coming from more of a PE DNA. And so I'll probably kind of keep coming back to this framework that I like to use with GPs, is that as you think about fundraising, a lot of the mistakes I find we can sort of put into a commonsensical or an analogous format with an enterprise sales cycle. If you were selling software, you were selling a product to a company. And so one of the, again, sounds very basic, but elementary things that I observe a lot is that people don't kind of do the research on the client before they show up. So the one example that I'll give is, we had a GP come into our office. We do, again, quite a lot of direct investing. We were direct investors in Cloudflare and UiPath and just a lot of enterprise companies. And this GP came in and was clearly just on autopilot and spent, 3 minutes explaining to us what cloud computing was, because you've wasted my time now, which I generally don't appreciate.
I think sometimes one thing I would say, the worst thing I hear GPs say in a meeting is too much, right? Yeah. Listening and understanding. Yeah. Okay, Karen.
Excellent. No, thank you for the opportunity to be here. Thank you all for joining us. I'm really excited for this conversation. So I'm Karen Welch. I'm the Deputy Chief Investment Officer at Spider Management Company. We are part of the University of Richmond and very unique in that we manage the University of Richmond's endowment and the endowments of about 30 other colleges, independent schools, nonprofit organizations. We manage about $6 billion as a single pool, which from the investment perspective is optimal. And we really think from the business and client perspective, it's ideal for the right set of client partners who share the same investment objectives, needs, philosophy as the University of Richmond. And so we are 100% aligned with the university and all of our partners. So it's a really unique model and opportunity. The worst thing I think I've heard is, as shocking as it sounds, I kid you not, we had a GP come in to meet with us and kept referring to us as the University of Virginia. Yes, we are in Virginia. We'll give them that. We're only about an hour down the road from Charlottesville. But rule number one, know your audience, know your prospect, do your homework, as I'm sure you all do.
So I think let's turn to some practical guidelines for building relationships, right? So much a GP is starting out. So whether you're an emerging manager or an existing manager, it's a tough fundraising environment out there. Most people are looking for new capital today in some way, which requires even the best of managers to start building new relationships. Let's start with just some practical advice or common mistakes that you see around people that are starting out new relationships with LPs. That could be things around the cadence of communication. What's the best way to start off on the right foot? What's the best way to stay on your radar? Let's talk about some of those practical realities.
I guess I would say, it is a tough fundraising environment, as Meghan mentioned. We have LPs as well, so we feel it, and we can 1,000% empathize and sympathize. I think it is highly unusual for us to commit to a GP who is previously unknown to us. The best way to get our attention is to have a warm introduction by someone who's going to vouch for you, whether they're, if you're focused on seed, if they're downstream from you at the A or the B, and they know us well, and then they will say, hey, anytime this person sends us a deal, we will take a hard look because they are, a subject matter expert. They are able to win deals. They've been good board members, et cetera. So I would say that, and then as a 1B, I guess, to that point, we are a big firm. We have a bunch of asset classes, et cetera. I would make sure that the quality of the referral, if you are able to find a warm intro to us, is a strong one, because you'd be surprised at how many times we'll get you and I are both on the email, and then we'll get a one-on-one email right after saying, hey, they asked me to introduce them to you. I've never worked with them. I won't vouch for them. So they asked me and I couldn't say no. That happens all the time. And so I guess that would be my advice.
Karen, you have a big team underneath you. Do they respond to cold emails?
We try to be respectful and professional, and so we certainly aspire to be responsive, but that's not generally the best way to really get our attention. So I think you framed this question perfectly in referring to it as a relationship. And we think about allocating capital as building relationships that are ideally very long-term, open, honest relationships. I had one of the former CIOs at Stanford talked about getting married to a manager. And as the flip side of that, though, is there's a long dating cycle. I like your analogy about the enterprise sales cycle. And so this is maybe not the answer that GPs want to hear, but I think we need to be realistic around what that time frame looks like, and not just cold calling or reaching out as they are immediately beginning to fundraise. The best engagement and opportunities are when they're not fundraising, when you have the opportunity to really get to know them in a deeper manner, when there isn't the sales element of it at that point.
So you meet a manager and you have an introductory meeting. You're starting to date, but you're not investing yet. What is the right cadence of communication from a GP who wants to stay on your radar, wants to keep you updated on how things are progressing, ideally so that you invest in their next fund? I think people struggle with this a lot because they say, okay, I've met them and they said they're not going to invest now, but I'm going to send them quarterly updates, or I'm going to try to meet with them every time I'm in town. Give some feedback around that, because I think it's something people really struggle with, and knowing, because they generally don't want to annoy LPs, but they also want to stay on your radar. So give some perspective on that.
And so, okay, so I would generally say about a once a year check-in is what, more than that, unless there's been some major change or victory, exit, I think those are, I would feel free to sort of chest thump about those, because especially now, they're very few and far between, and track record is really what's going to get folks' attention in that kind of that dating period. Absent that, with groups we are genuinely interested in getting to kind of know over time, sometimes we will say, feel free to add me to your quarterly distribution that's scrubbed for non-LPs, because we do want to kind of keep, at least a little bit of an eye on it. But in terms of a real live Zoom or update, like a legitimate one, I would say once a year.
I think that's generally the right timing. I think part of the reason why this question is so challenging is there's not, a completely standard answer, and it depends on what asset class, where you are in the fundraising process, what the environment looks like. So in addition, I would add thinking about opportunities that you can add value. And you do a great job with this. If there is something in the market, something in your business that's changed, that you have, or just something in the broader landscape and opportunity set, that you have information, you have value to add, you can share information, you can help to educate the LPs to make us smarter, is valuable, and I think a great way to get in the door and have a meaningful update conversation.
That's really interesting. I know we try to think about delivering value to our LPs in two ways, which is returns and insights. And I think we often focus on the returns piece, but the insights piece, I think, is undervalued. All of the LPs that we work with are fiduciaries in some ways, to the principal of their family office, to a board of directors, to a university endowment, to LPs of their own. And they need to report back. They're addressing questions. So, figuring out ways to help your LPs navigate complicated markets is genuinely, I think, genuinely valuable.
I think that's a great, that's very well said. And if it's okay, I'll use your example. Like, yesterday, the stock market getting crushed because of DeepSeek. And if some GP, if you have a point of view on it or some insight that you think is differentiated, and you sent that to me, even if we weren't, even if we didn't know you well, again, it's topical, it's subject matter expertise that you could be associated with. We would remember that.
I want to stay on communication, because we all know communication is the rock bed of relationships of all kinds. Talk to me about what great communication looks like, what transparency looks like. I think the industry does a terrible job of creating some sort of standard around transparency and communication. I think it's pretty established equity in public equity markets. You've got investor calls, people know what to expect. It's well managed. In alternative investments, it's a zoo. Everybody does it differently, and maybe there's not one size fits all. But what does great communication look like from a GP that you're invested with?
I would say for me, I'm kind of thinking about it in terms of, again, we talked about this a little bit, but just generally, there are rarely good surprises. So I feel like the number one job should be like, I shouldn't be surprised by something, whether it's a significant markdown in the fund returner in the fund that you're in, or that you've crossed over 7 times into different funds. That proactive communication, again, it sounds very basic, but it really goes a long way, particularly when things are hard. And I know it's sort of maybe not the human instinct where you want to kind of hide, But I think those are the times when you want to be more upfront because you get a lot of credit for that in terms of, hey, here's what I learned from it, or here's what's happening, here's what I learned from it. But also then I feel like I can trust you versus, we've had situations where there have been, where I know that there was fraud, right? And then we were told about it like, very loosely, very kind of surface level, and it never hit the press, and then it was never talked about again. And again, especially for us, where we've looked at companies directly, like this one company I'm thinking of, so none of the other LPs knew, and then never talked about it again. So I have real trust issues with that group now.
Yeah.
Because if I didn't do the direct investing and didn't know the backstory, as an LP, I wouldn't know that had happened. And so that's forever seared in my head.
Yeah. Karen,
No.
how about you?
I think the key underlying theme is to be open and transparent. I hate it when managers won't give us transparency. We are stewards of the University of Richmond and nonprofit partners capital, and you, in turn, are stewarding it for us. We need that transparency, and to have a successful long-term relationship, it needs to be built on open communication, trust, and transparency. I think you hit on two different types of communication that are often required when delivering bad or good news. Yeah. And I think that's important. You did a great job, Brad did a great job at your annual meeting in celebrating great performance and real positive news, and talked about the drivers, but also put that in context and recognized some of the period that had preceded that, which laid the foundation for that real successful performance and the lessons learned. And I think being introspective and candid is really helpful, even in the good times and certainly in the bad times. That you really need to take responsibility, to take accountability. Ultimately, it's the PM's responsibility generally, or the GP's. And I think you're a sports fan and a Notre Dame fan. I loved Marcus Freeman after the Notre Dame's loss to Ohio State. He owned that. I'm sorry, and bring up a tough subject, but he owned that. He shouldered all the responsibility. He didn't blame it on his coaching staff, the players. It was his, and I think that really, inspires a team and creates a longer, more successful relationship.
I think if there's one thing that I would leave to a generation of people that do fundraising and capital formation and investor relations people from the lessons I've learned in my career, is relationships are built when things go wrong. And things absolutely will go wrong at some point. The shit will hit the fan in your fund. And it is how you handle that draws real respect from LPs. The framework that I use is actually PIE, which is what's the problem, what's the impact of the problem, and what is my exposure to that. There is fraud in this company. The company's going to zero. What is my individual exposure to that in this fund? How exposed I am. And no surprises. My objective is always to get to an LP before they read something in the press. It scores a lot of points. And it's tough to do for bad news, and it's fabulous for good news. It applies to good news too. Yeah. Because what's going to happen for your LP is someone's at their organization is going to pick up the phone and say, hey, do we have exposure to this company? And for you to be armed with the talking points is really helpful. Okay, we have 5 minutes left, and I want to talk about navigating the current fundraising environment. It's really hard. And there's tons of funds in the market, and differentiation. We talk about differentiation. How does someone break through? What does differentiation mean to you? And this applies to venture, and it applies to all different parts of the market, but talk a little bit about that.
Go ahead.
Okay, so again, the team I'm on is focused on venture and growth only, so I'll talk about it in that context. But So if you break the venture job down into its component pieces, and I guess this probably actually applies to PE and as well, but there's the sourcing of deals, investment judgment, or picking the deals you want to invest in. You might want to invest, but you still have to win the deal or win the right to lead the round, and then the value add after the fact. Increasingly, a lot of the GPs in venture have gone to a very selective university and have worked at a big, or have some operating experience, whether they were a founder themselves or they were an operator at a tech company. And so it's getting harder from the LP side to differentiate on the sourcing and the value add, because the networks are starting to look the same. And then the value add, a lot of folks have experience to offer in terms of the movies they've seen before. And so it's really coming down to the investment judgment, which unfortunately in our asset class takes a really long time, but is performance. And or in the nearer term, you can look at proof points in terms of up rounds, or who's following you into deals or investing downstream from you. So there's some signal. It's imperfect, but there's some signal that we use. And then the winning deals, you can talk about a little bit more real time versus the investment judgment. But in that, because we've got a big team, we make a lot of calls and do a lot of diligence, we know, actually you didn't win that deal, but we know it was down to you and, name another sort of top tier firm or whatever. And so that's really how, we're starting to, again, it's just getting more and more competitive as the asset class, manager proliferation has really increased dramatically.
It's really hard out there. I almost think of it, it's like applying to college, right? As an LP, you're sorting through transcripts and resumes that in many cases look the same. Thousands and thousands of them. And it's a hard job. It's a hard job.
And I think just like college, that it's finding that mutual fit is really key. And so a manager that may be perfect for your portfolio may not be perfect for ours. And so we really spend time thinking about how differentiated a manager is relative to our existing portfolio and how it can complement the portfolio to help the portfolio holistically achieve our targeted objectives.
I think that people don't talk enough about the fit. It's not just about finding capital. It's about finding the capital that's right for you and how you define your business. And as LPs, you have objectives that you need to reach. And as GPs, it might be consistency. It might be flexibility. It might be scaling over the long term. So how are some of the ways that you draw that out of a GP, and how do you guys think about kind of that mutual
It's really thinking about alignment and being open and honest again from both sides around who we are, what we need, what our expectations are, and matching that and determining if that manager is best suited for that role in the portfolio.
So we have 90 seconds left, and it wouldn't be a topic or a panel with LPs if we didn't talk about the word of the year, which is DPI, or the term of the year. So 10 years ago, nobody talked about DPI. The term literally didn't exist in the nomenclature, and now it is really what everyone is talking about, which is the cash on cash, money in the pocket, return back to you. How do you think about that? How do you think about DPI relative to TVPI? What are how important is it for you to see a manager that has actually returned capital? Obviously, this is most relevant for the private markets portion of your portfolio. But maybe just reflect on that element for people that maybe have raised 2 funds and they haven't returned a lot of capital back yet, but they've got to prove their strategy over time.
Assuming we're talking about early stage, not some of our growth focused pools, I think if you're a 2017 vintage, I guess now that we're in 25, we'll kind of start to flip that over to 2018. It'll become more in the aperture, and you're at a 0 DPI, then we'll start to kind of ask about that. I think if you have DPI that that has organically arrived in a newer fund than that, that's great. To your question about whether it's manufactured or, again, there was just a natural exit. For us, I don't think we don't frown upon that at all. I will say, you know, we have a very large secondary practice, so we're often on the buy side. So just, you know, for full transparency. But I think it shows a level of awareness and understanding of the business. You know, we were talking earlier about sort of the non-glamorous parts of being a GP are understanding just portfolio construction math, reserves, recycling, just how you're going to get to the fund level return that you have told your LPs you're aspiring to get. And DPI, I think, falls in that category. And if you can get there, I think it shows a level of awareness about you just managing your business that is still a little bit, if you showed that, you would be exceeding expectations.
Karen,
It is the word of the year for good reason. It is absolutely critical. We need DPI in order to pay our faculty salaries, to pay student financial aid, and for our foundations to make grants in the community. We can't do that with TVPI, and so it's absolutely critical. And managers need to provide that liquidity and demonstrate a path to it. And I think, fortunately, the good news is there are emerging tools, as you noted, that can help to generate liquidity from less traditional means than we have in the past.
I'm just waiting. Thank you both so much. Thank you all for listening. We really appreciate you spending the time.